Hi everyone, this is Greg Kilpack, president of MarketTimingUniversity.com, and I just want to spend a minute telling you about what's going on in the bond market right now. Okay, bonds are a great thing to have in a portfolio to stabilize them because they don't move like stocks do. They're much more stable, but you need to know how they're priced. Okay, now bonds are based on interest rates like you see here. What happens in the bond market is as interest rates fall, bond prices go up. The reason for that is if I buy a bond, say a 10-year bond, and the interest rate is 5% on that bond, well, if interest rates then drop to say 3%, what happens to the value of my bond that offers a yield of 5%? Well, obviously that bond is worth more than what is currently offered in the marketplace at 3%. Okay, so the lower the interest rates drop, the higher my bond is worth because it pays a higher interest rate. And the opposite of that is true as well. When my 5% bond is what I have and the market goes up, say, to 7% for an interest rate, well, then obviously my bond is going to pay less, and therefore my bond price for that will go down. I can still sell it in the marketplace, but I won't get the same as what I paid for it. So if it was $1,000 bond, I won't get $1,000. I might get 900 or whatever, but it's not going to be worth as much. So that's the key thing that you need to know about when it comes to bonds. Now, looking at the big picture, what happens to interest rates when the economy gets really bad in the middle of a recession, like it has been the last several years? Well, interest rates go down to very low rates. They do that, they lower it to stimulate the economy. So what does that mean right now for bond prices? Well, they're going to be raising interest rates sooner or later. I don't know when that's going to come, but it's going to happen. And when that happens, bond prices are going to drop. They're going to lose money. So it doesn't really matter if you have a very short term, like T-bills, short-term held bonds. They're not actually called bonds, they're bills. But you don't want to hold anything that has a long term to it, or you're going to lose a lot of money. I would not want to be holding 10-year bonds or 30-year bonds right now at such a low interest rate, knowing that you can get a higher interest rate later. They do pay a slightly higher interest rate for holding a longer term bond. A 30-year bond will always pay a little more than a 10-year bond, will always pay a little more than T-bills, short-term, 30-day to 90-day bonds. But it's not worth the risk. In the long term, you're going to get creamed if you hold a 30-year bond to maturity at current interest rates. So just keep that in mind. If you're going to go bonds, make sure it's short-term maturity at this point. Short-term holdings. I wouldn't want to hold anything more than 1 year at this point. Now, 5 years ago, or anytime interest rates are really high, late 70s, that's when you want to hold the long-term bonds. So just keep that in mind. Thank you. Hope you have a great day. And get my free report at MarketTimingUniversity.com. The free report is how to earn greater profits, take less risk, and invest with confidence. Also, if you're enjoying my videos, please leave a comment. I'd really appreciate that. All right, thank you. Have a great day.